Let's talk about RSUs and how they're taxed. I work with a lot of high-earning professionals across various industries like tech, medical, and others, and I see the same thing over and over. The tax rules are confusing, they're not explained very well, and people end up with a surprise tax bill that their CPA never really walks them through. By the end of this video, you'll understand how your RSUs really work and how to adjust your strategy so you're not blindsided by taxes. I'm Brandon, founder of Galisi Financial, and this is exactly how I explain RSUs to my clients. RSU stands for Restricted Stock Unit. It's just shares of your company stock that your employer promises you, but you don't get them all at once. They vest on a schedule, which means they actually become yours over time. This can happen over a period of several years, with chunks hitting your account every quarter, semi-annually, etc. But here's the part that matters for taxes. The day that the shares vest, the IRS treats the full market value as ordinary income, same as your W-2 salary. So if $50,000 worth of stock vests in March, that $50,000 is added to your tax return for the year on top of your salary, your spouse's salary, and everything else. RSU income stacks, and that stacking is what creates two problems, which we're about to walk through. When your RSUs vest, your employer typically withholds taxes at 22%, assuming that you have the sell to cover box checked, which you most likely do. That's what's called the default supplemental rate that the IRS outlines. It sounds like it's going to be enough, but it very rarely is, and here's why. Our tax system is progressive. Every dollar after a threshold gets taxed at a higher rate. But the potential problem with this is you may or may not be in the 22% tax bracket. So if you're in the, say, 32% to 35%, that's going to become an issue during tax time. So let's take a look at an example of a sample couple making about $520,000 a year, which likely puts them in the 32% tax bracket after their deductions. Let's say they've got RSU vesting this year worth 200 grand, which means the company likely withholds about $44,000 based on that 22% supplemental rate. But the real tax hit on that 200 grand vest, once you factor in their actual bracket and just federal here, is closer to $64,000, which, in case you're keeping math at home, that's a $20,000 gap. And we're only talking about federal tax. So of course, state tax could push this even higher depending on where you live. So if this couple hasn't updated their withholdings, it's not going to be a very fun surprise when April rolls around. But here's the thing. The tax bill is just one of the potential issues that RSUs can create. We're also not factoring in some investment issues that RSUs can also create. Let's get into that right here. Most people think that their employer stock is just one of the many things that they own, which is probably true, but they have no idea how big the position has actually grown. And here's why. When shares vest, the company sells just enough to cover the tax withholding, like we just talked about, which is called sell to cover. The rest stays as company stock unless you sell it. 5 years of that can really add up fast. So for a couple like we've just talked about, it's easy to imagine that the employer stock has grown into maybe more than a third of total investable assets. The fancy jargon term for this is going to be called stock concentration risk. When we're investing for the long term, you don't want too much of your portfolio in any single company, let alone the same company that's also funding your household. Let's say that stock drops 40%, and we've watched that happen. Meta dropped 75% in 2022, Amazon fell by roughly half, and Intel dropped by over 60%. And that was just a few years ago. So not only could you potentially lose investment value in your portfolio, but also if they end up having a layoff round, you're going to see your investment balance go down. Also your income as well, if you're unfortunate and do get hit in that layoff round. So investments in paychecks tied to the same company's performance, it's not diversification. It's a pretty concentrated bet that most people don't even realize that they're making. Most people who finally start selling concentrated stock get hit with capital gains tax and assume that's just the price of doing the right thing, but they don't realize there could be an offset sitting in their portfolio that nobody's talked about and they're not aware of. Here's the strategy. Your portfolio probably has positions that are up, probably has positions that are down, and the ones that are down, those are simply unrealized losses sitting there. For better tax planning, you can take advantage of what's called tax loss harvesting. The IRS lets you sell those at a loss, lock in the deduction, and use those losses to cancel out capital gains elsewhere. Let's say that you've got $15,000 in unrealized gains, and since you haven't sold them yet, you don't pay any taxes. If you do sell those stocks, you could be paying about $2,300 in capital gains tax. But let's say that you also have shares that you sell for a $15,000 loss. Those are going to net each other out, and you're going to pay $0 in capital gains tax. That's the power of tax loss harvesting. Like most most tax strategies, there are trade-offs. You need to be mindful of what's called wash sale rules. If you sell at a loss and then buy that same stock back within 30 days, the IRS disallows it. And here's the trap that most people miss. This applies across all of your accounts. Say that you sell your company stock at a loss, so you can have that great strategy to reduce your tax bill. But then you get more shares through your employer stock purchase program, or there's another RSU vest that hits. Well, this is going to trigger that wash sale. So now the loss can't be taken this year, and it's going to get added to the basis of those new shares that you just bought or that just vested. So you've got to coordinate this across every account, including the ones that you might not think about as much. Tax loss harvesting makes diversifying cheaper and is an effective tax strategy. But when it comes to giving, there's something even better. Most people who give to charity simply give cash, not realizing that that's not the most efficient way that they could be giving if you're holding appreciated stock. And here's why. If you have stock that's gone up in value and you sell it first, you're going to pay capital gains tax like we just talked about. Then you donate the leftover cash. So the IRS just took a cut for letting you give money to charity. So here's the better move. When you donate shares directly to charity, you don't sell them, there's no capital gains tax, and the charity gets the full value of the stock. They sell it tax-free themselves, and you get the full deduction. Let's take the same couple that we've talked about before. They give $25,000 a year to their church and a few of their favorite charities. And their appreciated employer stock has $15,000 of unrealized gains. Let's say that they sell the stock first and then donate the cash. That could have them paying about $2,300 in capital gains tax. But if they donate the shares directly, they pay $0 in capital gains. Same gift, same church or charity, $2,300 less in taxes. Now, there is a catch. The shares must be held for over 12 months to get the full deduction at today's value. If you donate earlier shares that you've held for less time, you only get to deduct what you originally paid for them, which could potentially be a smaller number. So you'll want to target your oldest, most appreciated shares. And here's the bonus. The cash that you would have donated, you can use it to buy diversified investments instead. Triple win. Same gift, less stock concentration, more after-tax wealth. And real quick, if your church or charity doesn't accept donations of stock directly, you can open what's called a donor-advised fund. You can donate by transferring shares. Once inside the account, then you can sell without taxes and give the cash directly to your church. But here's the thing. None of these moves matter if you don't have a system in place that runs things automatically each quarter. Here's something that not a lot of people talk about. There's a psychological trap when it comes to RSUs called the endowment effect. Once shares are in your account, your brain treats them as more valuable than they actually are. You wouldn't necessarily go out and buy hundreds of thousands of dollars of your company stock in cash, but because the shares are already vested, they're already in your account, you don't sell. You hold them, you wait, and the position grows. But the fix is simple. Build a vest day plan. Before any shares hit your account, you already know exactly what's going to happen to them. What percentage gets sold immediately? Where do the proceeds go? You could go to your emergency fund, brokerage account, retirement accounts, down payment, etc. You decide once and simply monitor and adjust each and every quarter. Here's a high-level idea for you with your RSUs. Sell 50 to 100% on vest day, depending on how much your current investments are already tied up in your company stock. Then move the money to a diversified brokerage account or add to your emergency fund in a high-yield savings account, especially if you're worried about layoff risk at your particular company. Just remember, plan the vest, don't let the vest plan you. So here's your assignment. This week, sit down for an hour and run the math on your own RSUs. And if you don't have the time, or you simply want help running through this, schedule a free 15-minute phone call. You'll share more about you and your situation, and together, we'll see if it makes sense for us to start laying the foundation of your RSU tax strategy on a free Zoom strategy session. Just click the link in the description and let's chat. I'll see you in the next one.